Right, good evening everybody. 14th session on financial statement analysis. Now actually today we are going to discuss a little bit different aspect of financial statement analysis. Actually we need to look at today tools to apply to financial statements to identify errors, omissions and frauds. Why? What is the importance of this in financial statement analysis? Hope you have learned already financial statement analysis as well as business valuation, right? So in both the cases, if you can remember, actually we mainly, up to now, we mainly focus about output. That means how to do that. So very simply, let's say, if you take wrong data or wrong figures or wrong amounts from your financial statements to do financial statement analysis or business valuation, what will happen? Even though you use all these correct methods, what is happening for the final outcome? Outcome is wrong. So therefore, actually now we are going to look at how to make sure whether you are going to take correct input to your financial statement analysis as well as for the business valuation. Those are the two parts you have done already. One is business financial statement analysis, and another one is part of business valuation. Now you did both. You learn all techniques, methods, everything to do financial statement analysis, and you took different types of decisions relating to your financial statements, but still you don't know whether those data you use is correct or wrong. So therefore now today's lesson, we are going to mainly focus about how to make sure whether we have correct set of data or amounts from financial statements to do financial statement analysis. It's kind of a different aspect we need to look at. And that's why we said actually tools or concepts that we need to focus to make sure whether financial statements are providing correct amounts. Otherwise, everything is wrong. Let's say if you take business valuation as, so you did it with Chaturano. So let's say when you take business valuation of a company as, let's say 150 million. If your data is wrong, so no point, no. So everything is wrong thereafter. So therefore, in this lesson, we will see, actually already you have learned this part in different lessons. Actually in auditing, you may have learned a lot related to this, but we are going to look at it in different angle. And also in, if you can remember, in forensic accounting, Mudit discussed little about something like this, how to identify this financial statement frauds and all, right? So today also I am going to discuss something about this, how to make sure whether the information that you use is quality enough to make decisions. Otherwise, even though you use different methods very accurately, if data is wrong, again your output is wrong. Already up to within actually last 13 weeks we discussed about the process, not about the input. Now we are going to make sure whether the input is quality to make the decision. So process wise, like if you can remember, we use different ratios. We calculated ratios. Based on ratio, we go forward and interpret it properly. We use different valuation techniques, and based on that we learn how to value a business. Then based on that value, we decide, we make different decisions. But now we are going back and see whether the correct input is taken into this. Whether the input or data or financial information is correct, which we use to prepare these financial statement analysis and business valuation. Understand? That's the importance of learning different techniques or methods, maybe concepts, to identify errors, omissions and frauds. So that's the discussion today we are going to have. We will do kind of, actually now when we think about that, now the question mainly, final focus in the lesson is how to identify or how to make sure whether the financial information is correct. Financial information which is used for business valuation and financial statement analysis is correct. So how do you make sure that? Actually, before starting your financial statement analysis and business valuation aspect, we need to make sure whether our data is correct. We have to open our eyes in different ways. Actually, today I am going to look at it in 3 different ways. Right? One is actually how to identify financial statements, errors, omissions and frauds using our ratios. We can use ratios even. Ratios we can use to make sure. Now, ratio analysis is one part which we use to make business decisions. Same set of ratios we can use to make sure whether data is correct. Look, that's interesting thing. Understand? So that means we are going to look at some relationship of these ratios. Based on that, you can say our data is something wrong. If data is wrong, no point of doing other ratios and business valuation. Understand what I say? Ratios you can use to make sure your data is correct. That's one thing. Another area is you have some techniques to make sure whether financial reporting quality is there. If financial reporting quality and earning quality is there, no doubt what will happen? Your input is good. Understand? That means one area we need to look at. With ratios, we will see whether the input is correct. Second area, we will see whether the financial reporting quality is there. If the quality is there, no doubt what will happen? Your information is little accurate. Understand? Third thing is you can use your common sense. You can use your accounting or what is called financial management, or we can say even management common sense to find out whether there are some mistakes or problems in your input or financial statement information. Understood? So that's why I have given actually 3 files. With these 3 files I am going to discuss those 3 aspects. Now first, actually I prefer to use the common sense first. That is most important one. We have to have not the common sense like actually management common sense we say. Or accounting common sense we need to have. Accounting related common sense. So that's why I have given you sort of financial statement in PDF file that is there. I'll come into that later. Secondly. So then with that what I try to do is you need to use your general understanding as MBA students to look at set of financial statements and identify some problems or frauds or kind of omissions or errors inside it without using any ratio. No need to use any ratio. That's one aspect. That means it's not like general common sense. What is like business knowledge we have to have with qualitative and quantitative. With that we do. And also the other area is we can use ratios to make sure whether the data is correct. That's what we do now first. Right? With ratios we do first. Secondly, we use common sense to see whether we can have that kind of sense. Actually we call it sometimes professional skepticism. You can see it with that. And thirdly, we will see how to make sure whether financial reporting quality is there. Understand? So those are the 3 aspects that we try to discuss. And accordingly, we will start with the first part. Now, in this part, look, tools. Actually, the main tool we are focusing here is some ratios and already acquired knowledge relating to ratio analysis. So that's what we do in this area. Right? So I told most of people do business valuation and management will use different financial information to make their decisions, maybe business valuation, maybe reporting purpose, maybe to make other decisions. So the most important point, we need to make sure whether information or the data that we use to make those decisions is correct. So therefore, actually the data will be prepared or presented by different parties having different objectives. Probably accountants will do their job, but using the same data we have to use some other decision, right? Also, sometimes those people will be biased. Like let's say when accountants are doing the job, they need to make sure whether the job is done properly. They are also part of the management. Sometimes they are willing to show high income. If accountants are not willing to pay tax, what is their objective? They will underestimate what? Revenue or profit. So then they can minimize their taxation. But when it comes to management point of view or the shareholders point of view, they need to see the real financial position and performance of the business. So then the people who did it purely biased. So that impact is there. Also, financial statements will have some errors, omissions and frauds even. Those will be affected finally for the decisions that you take, maybe business valuation or other decisions. And also sometimes cash flows are very important tool. Actually, cash flow statement is derived based on what? Is it based on actual cash flows? No. Based on what? Income statement and statement of financial position. When we prepare cash flow statement, we take two statement of financial position or balance sheets and one income statement. With that, we will prepare cash flow statement. Based on that cash flow statement, we will make decisions. Then is it correct finally? If there are any mistake in income statement and balance sheet, what will happen? That will come into cash flow. Finally, that will be affecting to final decision. So therefore, we have to be very careful whether we take correct input to make decisions. So now today we are going to learn how do you decide that? How do you make sure whether you get correct data, right? So then we are going to discuss set of tools. I told you those tools are in three forms mainly. So you can use your accounting sense, one. You can use some ratios. Also you can use some techniques to make sure whether financial reporting quality is there. Right? So those are the main three things. Actually, we can remember there are two main qualitative characteristics. What are those? Relevance and reliability. If relevance and reliability is there, mostly what will happen? You can guess that. Actually, mostly reliability, or we call it actually faithful representation. If faithful representation is there, mostly you can make sure that the financial information or the input is fairly okay, right? There are different models. We will come to those models later. Actually, those three methods or three ways will help us to find actually hidden or what is called uncover frauds, errors and omissions, right? Let's see what we can do. Yeah, most of them I said. And also another point. Some in accounting we use different accounting principles and methods. Also in our what is called accounting standards, there are different choices are available. Based on those selections, what will happen? Our financial information will be changed. Based on that, our decision will be changed. Understand? So, and also another important point, there are some people, they are risk lovers. Therefore, they will take aggressive accounting principles. Like let's say every time they need to show their performance. There are some other people, they don't want to do so. They are maybe conservative or moderative people, risk-wise. Therefore, they don't make that kind of risk investment. They don't go for that kind of risk, high-risk accounting principles. As a result of that, they will go in different set of rules and regulations. Accordingly, what happens? Finally, everything will be affected to final decision and business valuations. Your income statement actually another important thing you need to focus about accrual basis concept. Accrual basis means even though we have not received some income, if it is relevant for the period or realized for the period, you can recognize it as income. Realized means kind of judgmental decision. There are some rules and regulations given by revenue recognition standard IAS 18, but still there are some judgmental decisions you need to make relating to revenue recognition, especially relating to timing, as well as the concept of realization. Also on the other way, there are some expenses which even though it has been not paid, even though if it is incurred, we take it as an expense. We call it accrual concept. Accrual concept will make kind of complicated scenario in financial statement analysis. Reason, even though there are no real expenses, predicting those, you can make. Very simple example, let's say, if there is any person has filed a case against the company asking compensation, purely the expense of the payable will depend on lawyer's opinion. Nobody else. If lawyers, they are also kind of guessing sometime. The final decision will be given by the court, based on available facts, based on available current facts. But they will say, okay, now you don't want to charge it as an expense or liability. Based on available conditions, sometimes they will say, no, you need to make provisions. It's purely not under the control of the business. Lawyers are also making their opinion based on current facts. sometime in the future, they will discover some other facts. Based on that, it will be changed. Understand? So therefore, as a result of that, what happens finally? Accrual basis will affect directly to your financial statement analysis as well as business valuation decisions. Right? So therefore, you have to make sure whether correct accruals are taken into their financial statements. How do that? I told you adjustments relating to timing of revenue. Actually, mostly people will do adjustments relating to revenue manipulation, asset value manipulation, valuation of inventories and all. So sometimes you will decide these are slow moving items and you will decide to write off it as an expense. Sometime due to market conditions changing, what will happen? From next month onwards, that will be fast moving item. Can be, no? But already you have written off as an expense. Assuming having current condition that it is slow moving item. No need to retain in the loss in the stock. You have recognized it as an expense. That's about problem on asset valuation. Also, expense concealment or deferment of liability concealment. Sometimes you have some chances to set off asset liabilities. Sometimes you don't want to show liability. Let's say in the previous example I told the lawsuit. What will happen? If any person is asking compensation, you will judge that. Now still judgment has not been given, therefore you will judge that. No, we don't want to make provision, we will win the case. Sometimes it's kind of favor decision. You have taken the decision based on your favor. You don't want to make a liability. You don't like to show liability in the financial statements. If so, if you show liabilities, your current working capital will be decreased. So therefore you will select that kind of decision. Those are kind of aggressive decisions we take. So as a result of that, finally what happens? Everything will be changed. Especially people who are using this information, they need to make sure whether they are the company or the accountants or the people who are preparing this information is accelerating or slowing revenue or expense appearing in financial record. It is not that much easy as we think. Right? When we get financial statement, set of financial statement, how to make sure whether they have taken correct amount of revenue? If you do an audit, yes, it is possible. We are not auditors. We are doing kind of analysis, but auditing sense also important in that case. We are not going to vouch expenses. We are not going to verify assets. We are not going to vouch income. But roughly we should be able to understand using different methods something wrong inside this. If you notice that something wrong inside it, you have to do adjustments to take to consider in your decision models. So that's what we are trying to discuss today. And also, like let's say, even you do timing adjustments for your income statement and statement of financial position, then you remember those are mostly short run. Why? Sometimes when auditors come, after several months, they will discover. But the problem is, before auditors are coming to the business, sometimes you may have taken some decisions. You take decisions based on your financial statement definitely before auditing them. You don't wait to make all decisions after auditing financial statements. After auditing financial statement, you may discover some items, the errors, omissions, etc. It's true. Auditing is one technique. We are not going to do an audit. But during the year also, you have to make sure whether the financial information is correct to make decisions. Every time you can't make decisions based on audited financial statements. It is not possible. If it is possible, it is good. But it is not possible. Sometimes unaudited figures will be used to make decisions. In that case, how to use your common sense or accounting sense to make sure whether statistics or the figures or information is correct. Right, now we will, this information anyway, you know, I don't want to explain all these. There are some areas you can understand. Actually, look the first bullet there. The results of the accrual method and the cash method of accounting produce the same results in long run from open to close of the business. Yes, it is true. Why? Look that point, it's very important. Now usually what we say, accrual, if you accrue something, you expect to get cash next, or you expect to pay cash next circle. If you look at the whole business process from the beginning to the shutting down the business, you don't have something called accruals. Why? At the point of winding up the business, you have to pay everything now. You can't keep it as liability or you can't keep it as receivable. So therefore, that's why they say there is no difference between accruals and cash if you take the whole business cycle. But we can't make decisions like that, no. There is another concept behind this. What is that? It is going concern. That means we don't know when to shut down the business. So therefore, we don't care about it. So therefore, there is a question on these accruals and deferrals. Yeah, actually now when you do any kind of, when we make any kind of decision relating to this information, you have to make sure, I told you, whether revenue are overstated, expense are understated, the both things are happen. So you have to make sure that the revenue and income, revenue, expense and assets are taken in proper values. Also when it comes to balance sheet, that's the last bullet I say, you have to make sure whether you have taken correct asset amount, correct liability amount and correct equity amount in your books of accounts. Otherwise, what will happen? Your financial statement analysis and valuation decisions will be wrong. You look this very carefully. What do you understand? Look this financial statement. If you look this financial statement very carefully, make few what is called comments or opinion based on this. What are your comments on this? Sorry? Sales are? Okay. What else? Constant, yes. Make now with this actually I can guess your financial accounting sense. Yeah, one statement you said. The GP ratio is significantly varied. Look the point. Vithanage, yes, it's true. GP ratio is significantly varied. Okay, what else? Is there any problem that I told you previously in this financial statement? Is there any problem like I told you previously? I told you have to make sure whether revenue is properly recorded. I told now liabilities assets are not there, no. Here you can see only income and expense. What else? In first year GP ratio is 50%. In second year it is 48%. Third year it is around 47%. Fourth year it's big one. It is 72%. Suddenly what has happened if you notice carefully? Fourth year, what has happened? Fourth year GP ratio has been increased significantly. Anything else? There is important thing you can notice. Can you see credit card expense? Sales double, it's true. Yes, sales double, more than that, from first year to fourth year. Credit card expense and the sales, there should be kind of direct relationship between credit card expense and sales. Why? Credit card expense means something related to sales, no? If you look at in first few years, first 3 years, 5,000 is to 100,000. Look, we can, now it is not a ratio. We have not learned that kind of ratio, no? That's why I said, even though we have used ratios, to make sure whether the ratios are correct, we have to see whether data is correct. In that case, sometimes we don't have specific ratio, you have to use your knowledge. Look, 5,000, 100,000 for 5,000, 150 to 7,500. Look, the percentage wise, 5,000 divided by 100,000 means it's 5%. Again, 7.5 divided by 150 means again 5%. 10.5 divided by 210 means again 5%. But look what has happened in the third year. Understood? 13 divided by 450. It is 2.8%. It means there is something wrong in sales in the fourth year. Maybe, we don't know exactly. But you have to discover that. That means you have to question thereafter. That's the point. With this information, you can't say, information is wrong. No, you can't make that kind of judgment. But there is something wrong inside this. But others are anyway going smoothly. It has been increased, everything happened. But mainly you have doubt about sales in year 4. Even though it is smoothly going up. GP ratio is little bit increased suddenly in the fourth year. One hint. Second hint, based on credit card expense, what has happened? You can guess something they have done in what is called revenue or sales, right? So therefore you have to think on that. With this you will, and also one more, value of the firm. What has happened to the value of the firm? It has been, look the way that it has been increasing from 67 to 727,000. Tremendous increase in now. In the first 3 years, it's fine, smooth growth. Now, what they have done? They have capitalized it now at 20%. With the purpose of valuation, what they have done, sometime they may have overstated their revenue or sales. Some kind of thing has been happened like that inside this. Understood? Right. Look this. What do you feel with this? Anything you can see in this? Any kind of, let's say, any kind of comment, at least one. You can see very easily. Huh? Yes. Can't hear. Net? Paper. What has happened? Yes, it's true. Inventory decrease. Look. Closing stock is decreasing over the period. It by 7 times almost. But on the other hand, what happened? Yeah. When inventory when inventory amount is decreasing, our sales increase. Yeah. Right? Also, debtors increase in 4th year due to the large amount of sales. Look, that's good point. Sales overestimated. Sometimes they have created what? They have given some promotions and all. Based on that, what has happened? They have overstated credit sales. They can create credit sales. Sometime in next year, what will happen? Now they need to take valuation. No? Therefore, what they do in this year, suddenly they overstate sales. Next year, what will happen? Most of them will be returned. No, sometime it will be bad debts, or they write off it as bad debts. Then you can reverse. Bad debts will not reverse to the last year. No? Only for that year. Sales return will be recognized into next year. No problem for this year. This year they have overstated everything, and based on that they have overstated the value of the firm. Understand? So that kind of thing can be happen in this kind of scenario, because suddenly one case easily they have overstated their credit sales by looking at this one. Understand? So now if you make your decisions based on this kind of ratios, what will happen? Now you can say net account receivable times not good, inventory turnover is good, something like that. So everything they have misled. So therefore you can't make judgments or decisions based on this kind of financial statements. Understood? So that's why we are going to learn or use our sense to understand these. Right. I told you why we need to make valuation of these. Just look these ratios first. There are some other ratios. Just have a look about this. Sorry? Return on? Yes. Yes. Look, sales growth suddenly 114%. Margin has been increased. Net profit, suddenly everything increased in the 4th year. Suddenly, return on equity, look, from 15%, what has happened? It has gone to 108%. Usually, we can't expect this kind of variance unless very rare even, there is big shift in the company. Within a year, you can't see this kind of big change. Even 15 can be maximum of 35-40. It cannot be 108%. So therefore, there is kind of hint on that as well. Look this. This is kind of company. Now look, table 3, based on those information ratios. Yeah. Sorry, those things I discussed already. Based on that, what you can say? There should be some concern with the ratios for 2004. That's our main conclusion. Those are the things we discussed already. The gross profit margin in 2004 indicates a significant decrease. I told this. In the cost of goods sold, while this might possible through technological advances, yes, it's true, but we have to think on that twice. That's why they say the change suggests further analysis is necessary, right? 5 additional ratios also give kind of red flags. What do you mean by red flags? Kind of negative hints. We call them red flags. The ratios are credit card expense. I told you, as a percentage of sales, it's kind of big area that you need to understand. And account receivable turnover. What's happening to account receivable turnover? Look, receivable turnover. It's not there. Yeah. Look, it's suddenly coming to this level. Look, 247 days, and turnover has been decreased suddenly. Look, it's 1.48 times, and most of the ratios there confusing. Days inventory turnover, that means we have sold everything very fast. Suddenly in the 4th year, it's starting from, look, 182, it has been decreased to 14. Drastic decrease over the period. And what else? Yeah, those are the things. Those things are there actually in these explanations. Yeah, those are things I already told. No, therefore no need to explain one by one again. Credit card expense story I told you. Finally, this means there may be kind of look. There are 3 points. Errors exist. Yes, there should be kind of error inside it. Also, the firm had an enormous increase in cash sales. Oh, is it possible? It cannot be, because there is big amount of creditors there, right? Oh, someone is falsifying sales documents. Maybe, right? Check cash in company guarantee fees may also be used for such an indicator. So therefore, you have to check whether those information is correct, right? Before making decisions on this financial information. Also, I told this, account receivable turnover, it's going down. I told this. Credit, it means this means that the credit has been extended, maybe, right? It has been increased number of days wise. It may be the reason. Also, the turnover was twice in a year, 183 days. Look what has happened. It has been decreased to 14 days. It's very impracticable. That's the reason. It means in the company, all slow moving items has become fast moving items suddenly. That cannot be. Only one type of product, no? Unless they have not changed their product, this kind of thing cannot be expected in this company, right? I told you about income statement and this thing, right? Another area that we need to focus. How people can, this is kind of general understanding, right? How people can overstate or understate, or we call it manipulate, revenue and gross profit, that area. How can you manipulate it? There are some different methods. I have selected only few, right? So just for your understanding, what will happen? Mainly you can make what is called overstatement or understatement of revenue very easily by changing its timing. Can you remember? How should you recognize revenue usually? When risk and rewards are transferred from seller to buyer. Risk and rewards, it's kind of judgmental fact. So what you can do, you can change the point. based on the fact, but it is not that much easy, but still there are possibilities to do so. Look then now, there are some examples where people can overstate to understate their revenue. How? A customer is permitted to take an item from a store for a trial period, but it is recorded as a sale. Look, it's possible now. If you are going to give a product for a trial period, sometime, even though it is trial, nobody can see sometime. So then you can recognize it as sale. Later they will return it. Understand? So that kind of ones. When goods shipped to customer are recorded as a sale and the goods are not recorded, why? Makes a return likely. So another area. Goods are rent to retailer on consignment. You know consignment? In that case, consigner recorded as sales. Can you recognize sales like that? When consignee sell this to the third party only, consignor can recognize revenue. But sometimes when you send goods, you have recognized it as sale, so it's wrong. And also this bullet is important, which is relating to our previous example. Another example of overvalue in a business is when sales revenue are recorded but did not occur and the accompanying account receivable does not exist. That means we call it actually false debtors. We create and record it as a sale. Change in timing and fictitious sales and receivables. There is no receivable like that, but you record it like receivable, later you reverse it, or you write off it, or you can recognize it as return. No worries, no. The return will be adjusted to the next period, so no worries. So that kind of things. And yeah, those are the things that I told you. Another important thing is cash scheme. Oh, we call it skimming. There are two things I hope you have learned with Mudit sometime. Cash larceny and cash skimming. What is that? Skimming means once you take off cash from the business before it is recorded, then you can hide sales. No? You sell something, but you don't record it in the cash registers. Without recording, you take it out. Like sometimes we encourage people, you do business, collect cash, without banking it, spend it. Then what will happen? If you have a big amount of inventory, sometimes you can do some adjustments. That means you collect cash by sales, you don't bank it. With that you make expenses. Then you can hide sales if you need. Right? If you need, you can hide sales. Because there is no record on that. But only record is inventory. Inventory will be decreased. If it is a service, very easily you can do. No track records. What you do, you don't raise invoice. You provide the service and get cash, but we don't record anywhere, then we make expenses. Some business, they can do like that, right? If the customer is not requesting an invoice, so you can do so. Right. And cash larceny means after recording sales, you can take off cash. It's kind of theft or the fraud. And also you have to keep your eyes open relating to the areas where large account receivables from new customers are created. So those are kind of big doubts. Suddenly if there are new customers with large account receivables, you have to open your eyes and see what has happened there. Also cost of inventory is another tool where we can manipulate revenue. Why? Cost of inventory is directly affecting to cost of sales. There, as a result of that, you can understate or overstate what? Gross profit. So therefore you have to open your eyes for the valuation of inventories. So and whether they have taken the actual amount of inventories into the stock and all, you have to see very carefully. And what is called gross profit margin, also another hint that you can see in the case of understating or overstating cost of sales and also sales, like we used the same in the previous example. And trade accounts payable shown on the balance sheet can be examined to see whether inventories was purchased. But recently I met actually a good scenario relating to this. Some people actually cancel. I'll come to that point later in other area, balance sheet area. And sometime There is another way of overestimation or underestimation of inventory. Look, the increased gross profit is to purchase large amount of inventory for delivery before year end. That means sometimes you have not bought goods. You have get into agreements with customers. You take the invoice and record it. Understand? So then you can overstate your purchases, right? It will not come into your closing stock. It is hidden. Right? So then you can overstate your cost of sales. And also another point, if you increase your gross profit, what will happen? It will increase the total assets as well as equity. Therefore, inventory valuation should be looked at very carefully. And yeah, those are things I told you. Same thing I explained. Now another area, expense manipulation. What is most common practice in our country? Personal expenses are recognized as business expense, right? So nobody can see one by one. So therefore you have to be careful. Even in new systems with our inner revenue department, you have to be careful how you recognize these expenses. And especially you look the second point, using inactive accounts to charge goods as sold and later remove it from the same inactive accounts through adjustments as bad debt. That's what I said previously. You recognize the same, or you write off it as same to profit and loss account as bad, right? So it's another area you need to look at. And also especially if you need to overstate your sales, what you can do, you can do a lot of promotions, and sometimes low quality goods you can sell into the market as a result of what happens in the future. There are two things, maybe more returns, and also there will be a lot of warranty claims if you give. Sometimes people will not provide claims of warranties. As a result of that, what happens? Your expense comes down. Understand? Then expense will be understated based on your warranty provision judgments. It is not good. Actually, how do you know whether they have done artificial sales at the end of the period? So you have to see the what is called seasonal variance of return. You can catch it very easily. If you draw a seasonal variance of sales return over a certain period of year, like let's say for 3-4 years, you can see a pattern. What is that? Every time at the beginning of the year, there is higher sales return. If you draw it properly in a chart, what you can notice, every year you can do the same for your business, and you can see, if you have a data, you can analyze it properly. At the beginning of each year, there is high amount of sales return. What is the reason? One is year end you will have more sales, it's true. You can take a percentage wise. This year sales and next year beginning or first month return as a percentage of that. It is increasing every time. Understand? Every time. If so, it means they are manipulating sales. That pattern you can notice very carefully. So based on that you can guess. They sometimes do artificial sales and it is returned in the next period, just to show year end financial performance well. Another important area is goodwill created and kept on records without. Did I take in a balance sheet? Oh, my expense management. Yeah, right. Actually, these are some items relating to expense as well as some assets part. Especially in the case of goodwill. You know, in goodwill, there are two types of goodwill: internal generated and external generated. Internal generated ones are not recognized as an expense, as an asset. But if you recognize external generated goodwill, or we call it goodwill on business combination as an asset, you have to amortize it over the period. You know that, right? So in that case, what happens? Amortization period will depend sometime on a kind of estimate. Also, you have to test it for impairment. If you don't amortize it properly, what will happen? Your expense goes down. And if you see that there is no decrease of recoverable amount, sometimes you will not recognize any impairment loss. These slides are not in LMS. Just see. I think it is there, no? Yes, PSS, I think slides are in the LMS. I uploaded it before starting the lecture. Yeah, yes, it is there, it is there. Right. And especially related to research and development cost. Can you remember those? From LKS 38 we done. Research cost, usually we recognize as expense. Anyway, you can't capitalize it. Sometimes quite difficult to differentiate research from development. It's quite difficult. From which point onwards you are recognizing as development? From which point before you recognize something as research cost? According to 38, what it says, research cost should be recognized as an expense while development cost can be capitalized if certain conditions are satisfied. All these conditions are management judgments. What are the conditions you can remember? Is there any economic inflow from the development product? Is there any feasibility? Then if you need to capitalize, what you can say, yes, we have everything. You can justify very simply. And also whether you have financial and other feasibilities. And also whether you have intention to complete. How do you make sure whether intention is there or not? We need to recognize it as an asset. You can say, yes, currently we have an intention. Later you can say, no, we don't have intention. As a result of that, you can charge the same to profit and loss account. Understand? So therefore, in the case of research and development cost, you have to be very careful. Mostly people do mistakes or sometimes knowingly or unknowingly, they do kind of changes in these research and development costs because it's quite difficult to differentiate those, even though we have definitions. Can you remember definitions for research and development costs from 38? What is research cost? I'm sure now you can remember. What is research cost and development cost? At least you should remember what is the accounting treatment. Research cost should be recognized as an expense to profit and loss account, while development cost should be recognized as part of intangible asset, if certain conditions are recognized or met. Right. Yes, I told you same. And another important area is related to expense and liability concealment. A transaction missing from the records is difficult to trace, really difficult to trace. I met recently a very good example, one of the case study made by one of our students. The story is like this. It's like a gold manufacturer, gold means jewelry manufacturer. You can so that kind of one, not hadanai, the jewelry shops. There's a jewelry shop. What they do, they buy biscuits, gold biscuits, and what they do, those biscuits are sent, not sold, sent to the craftsmen, the people who manufacture gold, or the people who produce gold jewelries. Then what they do this transaction through current accounts. This is a real scenario, right? So when I buy gold, but how can I recognize gold biscuits? That inventory account, debit, it's kind of raw material for me. Debit and credit to cash or creditor. That's done in my accounts. Then what I do, let's say you are the craftsman. Then I send gold biscuits to you to manufacture jewelries. In that case, what I do, I recognize this through a current account. What I do, current account debit, that means let's say you are X, current account with X, debit, my inventory account credit. Then gold with whom? Gold with you. Understand what I said? Understand the story first. Then what you do, you manufacture gold jewelries and you send me jewelries and I value it and recognize it as my finished goods. Current account credit, my finished good inventory account, different types of jewelries, right? Maybe necklace, bracelet, everything. Those are debit and current account credit. How I can make the payment for you for charges that you charge? I pay it by gold, not by cash. For the craftsman, I pay by gold. How should I pay by gold? There are remaining gold. You don't give it to me. Gold use gold. The payment is made to you. How? Using gold. Now if then finally I have only a current account in my account. Right? There may be debit or credit balance. If it is debit balance, it means there is a receivable from you. If there is any credit balance, there is payable to you. Understand? They show that as payable or receivable. What is the accounting problem in that kind of accounting treatment? Understood what I said? Right? I'll brief it again quickly. There's a jewelry shop. They buy gold biscuits. Send it to craftsman to manufacture gold jewelries. Craftsman will manufacture jewelries and send back to the jewelry shop. Let's say jewelry shop. The jewelry shop will pay to craftsman for the service or the given a charge by gold. Because there is some residual gold. It is given to the craftsman. Understand? It is recorded through a current account. Understand? Then when I send you gold biscuits, current account debit, my inventory account credit. Raw materials, biscuits, inventory account credit. When you send me jewelries, my finished goods debit, current account credit. If you charge something as expense, my profit, the current account credit, my expense account debit. Amount you charge, the amount of gold you charge as your kind of what is called service charge or service charge. What is the problem in this? What is the problem in this transaction? Is this correct? මෙහෙම accounts තියෙනක හරිද? It seems like correct. What is the problem? There is a problem if you do so. You hide something. What you hide? It is relating to the first point, not first point. It is relating to asset and liability offsetting. You are offsetting asset and liability. You are violating LKS number 1. The principle is offsetting principle. Can you remember? Something happening like this in transaction. You hide it. As a result of that, you have good benefit. What is that? You recognize, you estimate, you mislead your total sales as well as your cost of sales. Also finally gross profit, everything misleaded. Also you mislead your current assets and current liabilities. You don't show current asset, current liabilities properly. Why? When I send gold, gold is not belongs to you. I am not allowed to recognize it as gold with craftsman. Why? Gold with craftsman is an asset to me. It's my gold. Understand? In my transaction process, what happens? It shows as your gold. The craftsman doesn't have any kind of right to have this gold. Whose gold is that? It's the jewelry shop gold. It was sent only to manufacture jewelries. Understand? So therefore what happens? My inventory is understated. Also, there is a payable to you. What is a payable? For the manufacturing process, I have to pay you some money. It is reconciled or it is cancelled or it is offset against the current account gold balance. It is not correct. I should recognize it as a separate payable. Accordingly, what has happened? I am understating my liability. Also, I am understating my assets. On the other hand, what happens there? As a result of inventory underestimation, I hide my gross profit. I reduce my gross profit asset. Look the problem. What is that? It's kind of complex transaction. Finally, they are offsetting assets and liabilities, violating the offsetting principle. Right. Also, there are some other areas. Yeah, there are some other examples also. We'll see what are the important ones there. I have given a lot of examples, but no need to take all these. Yeah, there are some other hints that we need to see to make sure whether these items are correct or wrong. What are those? Look, this one, bank records. maybe kind of useful document that we can track all this information. Accounts payable turnover, accounts receivable turnover, everything will be important thing. And existence of long-term liabilities also will be important thing to make judgments on these. And especially you have to focus on legal judgments. I told you some examples related to litigation cases. It's another important tool. Also look here, tax returns are kind of important tool to assess. Like let's say if you have paid tax amount of this much for the inland revenue, you can guess what is that? What is your total revenue based on that? So even now, if I don't pay, now pay tax, pay as you earn tax is kind of good measure to do the same. So actually withdrawal tax imposed by the government, what's the purpose? There are two purposes on that. One, it's good thing, even though people now, it's how much? One rupee, or 1 rupee for 10,000. No, not 10%, small amount, as I remember. 1 rupee, no? 1 rupee, around 1 rupee for each 10,000 rupees. Withdrawal tax, I can't remember. If you withdraw money from, I can't remember the amount now. Just see the internet, it's there. For each rupee is 10,000, as I remember, 1 rupee. Is it? Anybody who can remember? I can't remember actually. How much is it? What's the purpose of implementing that kind of one? Reason is people will put into the financial system in the country. As a result of that, they can track black money. That's one thing. And also other one is they can count people consumption. Based on that, what they can do. Let's say if I pay withdrawal tax of 10,000, it means 10,000 into 10,000 times I have consumed. It means there should be kind of income like that. They can track my income as well based on the same. You can remember there was something called debit tax few years back, many years back. What is it? Okay. It's on 10%. It's again 10%. With, those are withholding taxes, no? Okay, what else? I think not withholding tax, withdrawal tax. Withdrawal tax. Withdrawal tax. Not withholding tax. Withdrawal tax. How much? Not there. Anyway, it doesn't matter, right? So then the purpose of that few years back we had withholding, no, what do you call debit tax. Purpose is the same. Tax charges for from 1 million to, yeah, it's good. Yeah, it's true. The question is the level. What it says? From 1 million to 2 million, 2%. No? 1 million to 10 million, 2%. 2% means if you withdraw 100 rupees, 2 rupees. That's the meaning, right? Withdrawal tax and 3% from 10 million above. If you withdraw more than 10 million, means if you withdraw 10 million, how much you have to pay? 2%. Means 200,000. You have to pay as withdrawal tax. Right? So that's kind of big one. It will be a final tax anyway. If you are withdrawing cash from the bank. Yes. Right? So based on that, what government can do? It will be remitted on my name, no, to the inland revenue. Then what they can do? They know my total consumption for the period. Based on that, they can guess the tax, my personal tax even. So the same purpose we had with the withholding tax few years back. With not withholding tax, debit tax. Debit tax, when we withdraw money, they charge 1 rupee, no, or 1,000 or something. something like that, right? Right, anyway, that's kind of intention, and therefore you can understand tax returns will be kind of important document which you can use to track all these information. Finally, what I need to say with these different types of ratios, and already you know the ratios, therefore I don't want to explain one by one. When you make records, you have to be careful about whether the data used as input is correct, and you have to use your general understanding common mostly with some ratio understanding knowledge, and there are some different documents that you can use to help to make sure whether your what is called financial data is correct. So then we'll see how can we use our common sense or our general understanding to identify what is called errors, frauds and omissions in financial statements to make our decisions. Let's see. Hope you have this document, PDF document. You need to have a break. We need to have a break. You can have 5 minutes break. Okay, 5 minutes. We will have 5 minutes break. Come quickly. During these 5 minutes, online people, they don't want to have break, no? Only people who are in the class, they need to have break. And the online people, you just download this PDF document. I'll give you exercise for them. And see what are the errors, omissions or mistakes. You don't want to use any ratio. Don't use any ratio for this. Without using ratios, you use your accounting understanding, basic understanding to see possible problems, maybe errors, omissions, mismatching information, something like that, in this given set of financial statements. That is your task, right? Okay, go and come quickly. There you go. Fortunately, right. Right now, I have given you a PDF document there, right? So then, can you show me some problems in these financial statements? No need to calculate any ratio, huh? Without calculating ratios. You calculate ratios, you can see these are the variances, everything you can see, inventory turnover, that is gone now already. You don't want to calculate ratios. So that it's another way that we need to make sure whether our data is correct. Actually, now we will make decision based on this financial statement. By having kind of overall understanding, you should be able to see some problems in this financial statement. Do it quickly. Try to find. Hope you have to download the document from the LMS, otherwise you can't scroll here and there. I'll keep on this page, but you just go here and there, you can do, no? Right? You can download the document from LMS, and you just see, you should be able to find at least 10 problems, right? We'll see whether you have, we call this actually nothing else, you know, as accountants, we should have 6 senses. 6 senses. Usually in Buddhism we call there should be 5 senses. What are those 5 senses? What are the 5 senses? It's kind of general thing also. Eyes, nose, ears, tongue. Eyes, ears, nose, tongue and skin. Those are the 5 senses. As accountants, so we call it actually financial people, there should be another sense. What is that? Huh? Not common sense. Not common sense. Common sense everybody should have, no? Not common sense. We call it professional skepticism. Nobody can give it. So that is experience purely. Now everybody has these main 5 senses. Ears, eyes, nose, tongue and the skin. You can take all these inputs to the body based on those 5. But remember, the professional skepticism, nobody can explain it, nobody can give it. Based on your everything that you have taken from small age now will be used to decide, especially your what is called professional skepticism in your professional work. You just see whether you have professional skepticism in this and see. I'll come by 1 minute. How many items you discovered now? You should have exactly. See, around 15 you can find. Yeah, it's close to 15 you can find. 15 problems. Actually, even I just say this thing, no point. No. I mean, you are not going to get the real meaning of this lesson. This part you should do. This kind of interesting game, you just take a. Actually, people who are in inland revenue department, they should be able to do this very carefully, right? There are people who are in inland revenue department, they should be able to do this job very well. Now, looking at financial statements, first before calculating those, you should be able to give kind of these are the mistakes we have done, very simply. Right? How many items you discovered now? Done. Yeah. Now look, the things, that's what they call, we can't teach this. The other methods, models now, thereafter we learn something called, already we have done Z-score model, which is used for bankruptcy prediction. We do another model called M-score model. It is for what is called test the reporting quality. Those are there. Those are, actually those can be taught to you. But this can't be, we can't teach this. You should use your professional skepticism and understand what has happened. Look very carefully. That's why I did previous lesson. There I told you need to look at this. You need to be careful in this area. You need to look at this based on ratios probably. Now you just see this and what are the mistakes that they have done. Some are errors, some are purpose they have hidden some information, some are misleaded totally, some are actually very clear, just omissions or maybe sometimes silly mistakes that they have done. Look one by one, very carefully. In Excel only easily you can find because some calculations and all others you can check. Now look the first point there. There is a fixed deposit here in the balance sheet. Right? There is fixed deposit. See whether there is any income. No income. One thing you can guess, fixed deposit has been opened or done at the end of the year. If so, yes, maybe. Otherwise, it will be a problem. Understand? That fixed deposit was not there at the beginning of the year. Last year it was not there. It means they have opened it in this year, very clear. If it is there in the last year, definitely there should be income. It means sometimes there may be income underestimation. If it is open during the year, alert one. Number 2, look about trade and other receivable note. It's about 4.22 million. Go to note number 9. It says 4,322,000. Understand? It is wrong. It is not agree with the note. 4.22 in note number 9 you can see. What is it? Correct amount is 4,322,000. Ilakkam marula deen. Understand? There are 4 million 4,222,000. There you have 4,322,000. Understand? You have to check everything. Got it? Right? It's another mistake. Then again we look. Look, there is bank overdraft. 143,000, but no overdraft interest. Understand? Do you see? You just say there is no bank overdraft interest. You see, overdraft interest 0. It cannot be, no. If there is an overdraft, definitely there should be kind of overdraft cost interest. There is overdraft in the last year also. Understand? Even though it has been settled during the year, there should be, it is compulsory to have, but OD interest. You see, there is one. EPF salaries vary. PSA, yes. We'll see that, right? Only one person made discover one thing, right? From the online people. Yes. Tax department, no? Yeah. We'll go and see. PSA, you should be able to see more than that. You are from the tax department, no? Only you look at EPF and EDF in tax department, is it? There are a lot of other mistakes that they have done. They have hidden some income. They have understated some expenses. Easily you can catch it, right? So let's see. Right, anything else? See, now I discovered 3, right? Anyway, I have done already, so therefore I know what are the mistakes. Then what about reserves? The total reserves, it's around 898,000 in the statement of owner's equity. But what is reserves in your note there? What is reserves? It's something else. Look the reserve note. Note. There is something wrong on that. Last year reserve, it is not matched. Also, you can see another one, important one. What about the PSA asset? It's about EPF ETF. See whether it is correct. ETF expense 190. 190 divided by 0.03. Then total salary should be around. Yeah, salary is not matched with that. Look, ETF expense, EPF expense is how much? 1 million to 1.2 million. But so total salary and allowance is how much? It's very small amount. Understand? So that means they have undercasted expense sometime. Got it? EPF ETF is not reconciled with salaries. There is another one. Look, rent. There is no rent in this year. But if you look at balance sheet, in note number there is a key money there. Look, there is key money in note number 9. In note number 9, you can see key money. If there is key money, what should have? There should be rent expense for the year, but there is no rent here. Rent expense is not there. For the last year, rent expense is there, but sometimes you can say the 1 year, over the last year, they have not claimed the key money. No, it cannot be. It's another problem. You should claim the key money, when you give up the rent premises. So therefore, there is a problem there. Another one, there is fuel. What is that? What has happened to fuel? There is fuel expense. But is there any vehicle? In property, plant and equipment? Sometimes if you have machines, you can understand. It is also not there. Understood? Machines, fuel, nothing there. Got it? Order of interest I told you. And if you go to the PP note, there is no name board which is fully depreciated. Sorry, made a mistake. There is no name board, but accumulated depreciation is what happens? What has happened? More than The total name board value. Did you see? Name board cost is 4,600, but accumulated depreciation is 5,750. Understood? Cannot be, no? Look, the items that we need to look at. මෙහෙ මේකින් අපි financial statement analysis කරොත් මොකද වෙන්නේ? The picture is totally wrong. That's the message I need to pass. Before doing that, you have to use your common sense and see whether these statistics are correct according to your understanding. Look, the total of beginning balance here, 34,401. This balance, 34,401. It is also not correct. 34,401. That is property, plant and equipment note, beginning depreciation accumulation balance, accumulated depreciation balance. Beginning accumulated depreciation balance. This is also wrong. The total is not wrong. Total is not correct. Total should be 37,401, but they have taken it as 34,401. මෙහෙම වුණත් account set එක balance වෙලා තියෙන්නේ. That's the problem. Look, right? Still, the account, the balance sheet is balanced. You just see whether the balance sheet is there, tally. Yes, it is so. No problem. It is there. 407 as 4,730,000. That is balance in figure. It's balance. That means offsetting one by one. That's the thing. They have hidden something somewhere. Nobody can see it. Right? What else? What are other possible problems? That is a very interesting one if you see. If you notice, inland revenue people, they are really interesting in this area. If the PSA can see, just tell me what is that. There is another important item relating to, I will give you a kind of hint. Somewhere in note number 9, 10, 11, just see. Somewhere there is a problem. Not there. Sorry, made a mistake. Sorry, not there. Note number 12, 13, 14, 15. No, wait. Yeah, in note number 9, 10, there is a problem there. Just see. What is it? Note number 9, 10, 11, there is a problem. Inside those three. You draw your attention there is a problem. Anybody can see it? Huh? What is it? Look, yes, it's true. Same account number, NTB, same account number is appearing. Where? Where is that? Under cash and cash equivalents as positive balance, also as well as overdraft. Can it be? No, it cannot be at all. There may be a mistake or erroneously they have done something. Or they have done something purposely. Sometimes the account number has been taken in wrong way. What else? That's another interesting thing in note number. That's a place where we have hidden. They have hidden everything. All these offset balances, the net impact has been taken into that point. What is that? Just see. In note number 12, there is a problem. What is that? Huh? Balance means? Yes? Yes, exactly. Look, what has happened? Last year brought forward balance. When it comes this year, it totally has been changed. That cannot be. Right? So it's a mistake. That's the place where they have done all these adjustments. The net impact has been adjusted into that to balance the balance sheet sometime. Understand? What is the other one? Anything else? Yeah, it's true. Net profit is not in line with changes in equity. It's also true. Yeah, it's correct. Net profit problem is there. Look, the net profit is not in line with the changes in equity statement. Net profit is 1.235 million. Not in line means, I don't know why you say not in line. Last year they did, I think. Yes, it's about last year data. Right, and what about director's current account? What do you think about it? Note number 13. The positive one has become negative one, means now previously it was payable, now it has become receivable. Director's current account, you have to recognize it as receivable, it's minus now. Under liability there is a minus, means debit balance. That debit balance should be classified as receivable. Understand? Another problem. Anything else? There is one problem. Look, under note number 14 there is a problem. Just find it. In note number 14 there is a problem. What is it? Yes, good. Okay. Yes. Maximum it should be how much? Audit fee payable maximum should be 50,000. That's the worst case. If you are not paid any amount during the year, because last year 25,000, right? This year also 25,000. It doesn't matter. It doesn't matter. It is constant. But the problem is there's a payable of 55,000. It cannot be. So last year one also not paid. This year one also not paid. Even though that we have to have maximum of 50,000. But here we have 55,000. It cannot be. Understand? So those are the problems we identify. To look at financial statement, but I need to show you finally. We need to have general understanding first than all others. That is final message. But we can't teach it. We can't teach it. There is no model, but I can give you a model to test. In the next part, we do kind of thing called M-score model. It's very easy. Model is there. What you can do? Take the probability values and variables, apply into your thing. We did Z-score model. Can you remember? Easy, no? Score is taken. Based on that, you can say whether there is kind of worst scenario or not. It is very easy. Anybody can understand. Even small people can understand that. But this thing, nobody can give. So this is kind of difficult area. So therefore, you have to have kind of understanding on this. We call it overall understanding to look at financial statements as a whole before starting your valuation or your financial statement analysis decisions. So that is the message finally we pass from this. Understand? So we move for the third area. Anybody who is sending a message? Yes, exactly. Somebody said PSN, yes. You are very keen on audit fees, I know, right? If audit fees increase, no, it cannot be, no. No, your argument is still wrong, remember. Now what he says, if audit fees increased, no, it cannot be, no. Why? If it is increased, it should be recognized in your income statement. It is not there, no. Income statement also recognized for the current year. If you look at income statement note, there is note number. You look at note number 5. Audit fee is 25,000 for the current year. If you have not paid for both the years, that should go maximum of 50,000. Is there any possibility? You got it, no? Yes, right? So therefore, you can see, you can have the more than 50,000 as payable. It's kind of mistake, right? So sometime you can say they have paid kind of professional charges or something. It means they have not recognized the expense. If so, otherwise it cannot be. Understand? Right. So anyway, now hope this will be really interesting to PSA because they do this kind of things. No, people will do this kind of small mistakes in financial statements. There are a lot of cases where we can find this kind of things. This is artificially created one, just for learning exercise. Otherwise, you can't see this kind of big mistakes or some silly mistakes. You can't see this kind of ones in financial statements, especially in audited financial statements. You can't see. Probably even sometimes auditors also do mistakes like this. Even in audited financial statements, there are some problems we have seen, right? So then, when printed ones, we have seen sometimes some mistakes are there. Maybe some printing mistakes or some others, but there may be. All right. Now let's move to the third area that we need to discuss. You do research, no? This is kind of interesting area if you do research, especially accounting research. Easy things, no? You see, most of the people, what they do corporate governance. They do CSR. They do, it is called CSR, corporate governance. There is another area, very working capital. What is your area? Probably out of those three, one will be. What is it? Corporate governance. Look, those are the very famous three areas of doing research. But no point of doing research on those areas. What's the purpose of doing it? Now, most of people, they have done enough number of research, but this is kind of really now actually if you need to do good research, at least, right? I did some models, if you can remember. Apply those models and see what has happened for the failed companies in our country and the good companies. Test it and see whether it is happening in a particular sector. What's the nature of that? So we did Z-score model. Using ratios, you can predict it. Predictability of this using this model. What has happened? Right? So and some qualitative factors you can put into that. Today I do another one called M-score model. So then based on those models you can do something very easily. You can see whether the financial statements having enough reporting quality. You have to measure it and see how the sector-wise it is changing. You can do it. What sector is having the good financial reporting quality in our country? How do you decide? Have done anybody? I don't think. So look, there are research. Right, now let's see. I told you the third area I need to focus. This is kind of fully technical. Therefore, I don't want to do that much. I need to give you kind of basic understanding on this. That's enough. Because fully technical, we need to have a lot of maths knowledge on this, and a lot of kind of too technical models are there. So actually, we should spend at least 3 hours on this. But in this level, no need. This is financial statement analysis now. Right, now in this case, what we try to do is, we need to make sure whether we are taking good quality information to analyze. Even though we have good tools to analyze, like common size financial statements or trend analysis, horizontal analysis, then what is called ratios, everything we had. Even though we are expert on those, if we do not have quality financial reports, what will happen? No point of using those. So therefore, you should be careful, or you should be assessed whether your financial statements are providing enough reporting quality, or whether they are providing good quality information. Now the question is, how to measure the term quality? How to measure the quality? Quality will depend. Quality is kind of judgmental figure. Let's say now, if you are going to buy a shirt, you will say, this shirt is good quality. But I will say, no, it's not a good quality. What is that? Based on your measurement, sometimes based on your interest, based on your kind of thinking pattern, based on your income capacity, based on the social level, everything, you will say, no, this is good quality one. But based on my assessment, I will say, no, it is not a good quality one. It means it depends on people perception. Understand? So therefore, it's quite difficult area to judge. Really difficult area to judge. Why? Purely depends on the perception. Even if you take, like, let's say, financial statements. The investors are looking financial statements in different angle. Lenders are looking at it from different angle. Managers are looking at it from different angle. Sometimes when managers are saying, yes, my financial statements are providing good quality information, sometimes investors will say, no, it's not so, because it is not matched with their requirements. Sometimes banks and lenders, they will say, oh, no, your financial reporting quality is very bad. Now, how do you make that judgment? Now, the question is, basically we have to understand in this area, that is an important area that I need to focus with you, to show you what does it mean by reporting quality, very simply. Right? So what is quality? If you understand what is quality, probably you can assess actually whether it is there or not using some models. If you don't know what is that, it is a question, right? So actually, mostly you can see some terms called financial reporting quality, then accounting quality, and earnings quality, and results quality. So those are kind of interchangeably used concepts in accounting, and there is kind of demand in this area to do research. Even you are following accounting course, nobody is doing accounting research. I don't know how many people do accounting research. I have not seen. Very rare, no, I think. What is your topic? You can remember? My God, you can't remember your research topic. Right, anyway, you are doing with Professor Jayamano. I think there is deadline also. You have to submit your reports. When? March 15th final proposal. Next week, you have to submit final proposal, but you can remember your topic. Is it? Your presentation next week? My God, right, okay. But I notice most of the people do research on those 3 areas, nothing else. I'm 100% sure. Or something relating to debt equity. No. Why? You have to continue the same, no? Is it? You have to take a new one. I don't know exactly. Usually it is easy for you to continue the same for the next year, if you have good job. Otherwise it will drag in. Developing proposal. No, if you take this proposal for the second year, It is good to take. Why? It has advantage to you. Because your workload will be reduced. Because you have at least you have studied 1 or 2 articles for this now. You can continue the same. You develop another one, what will happen? It's another headache. Why? You have to develop new proposal. So therefore, better thing you have to select a good research topic in this semester. Then you continue with the same for the next year. Then it will be easy for you. But I think you can change if you need, based on the advanced learning in research. So anyway, it depends. Right. Yes, we were talking about now reporting quality. Let's see what is it. Look, what is it? It is basically relating to the way of disclosing information. Right? High quality reporting provides decision useful information. Look, that is what we call reporting quality. What is reporting quality? Reporting quality means how do you achieve decision maker's purpose? Very simply. Whether you can achieve it, very simply. The different interested parties will have different objectives. How do you achieve it? If the achievement level is high, you can say reporting information is quality, right? Information that is relevant and faithfully represent. Look, if information that is relevant and faithfully represent, relevance and faithful representation, can you remember? The economic reality of the company's activities during the reporting period and the company's financial condition at the end of the period. That's what we call good or high quality reporting. What do you mean by high quality reporting? You should be able to achieve decision maker's purpose, or we call it should be relevance to your decisions you take, or we call it decision useful information. If you provide decision useful information, we call it is high quality. To provide decision useful information, what you need to do? You have to keep relevance and faithful representation. Can you remember those in accounting framework? Right? And also remember, when you provide relevant and faithful information, those should come from real economic activities. And also, it should be relevant to your real financial position at the end of the period. That is related to very basically performance and financial position. Understand? But mostly people use use this concept interrelatedly. How? What is it? Earnings quality, or sometimes people say results quality. Results quality means same, earnings quality. What is earning quality? It is relating to earnings and cash generated by the company's actual activities. That's purely relating to current economic activities or actual economic activities and financial condition relative to expectations of current and future financial performance. That means in income statement, very simply, it should show the actual earnings and cash generations from real economic activity. Also, the results should show the current and future financial position or performance, means something related to balance sheet. Understand? So that is earnings quality. Earnings quality means your earnings and all these inside transactions should, earnings and cash both. Inside earnings quality, actually we look at earnings as well as cash flows. Both should be relating to genuine real economic activities, and the result in financial condition relating to current and future financial performance. Understand? I told you earning quality is same as results quality. Now you hope you can understand what is reporting quality means. It's like external driven. You can understand, right? Now with this you can very simply guess. If there is no reporting quality, can you assess earnings quality? Give me an answer for that. If there is no reporting quality, can you assess earnings quality? What is reporting quality? That means if reporting quality means the information which is provided through financial statement should be decision relevant or decision useful. Now what is my decision? If it is not so, if it is not decision useful information, can I assess about earnings quality? No, you can't. Understand? Therefore, there is relationship between earnings quality and financial reporting quality. Understand? The concepts of earning quality and financial reporting quality are interrelated because, look, correct assessments of earning quality is possible only when there is some basic level of financial reporting quality. It means if there is no financial reporting quality, you will not be able to assess what? Earnings quality. Understand? Beyond the basic level, as the quality of reporting increases, the ability of financial statement user to correctly assess earnings quality and to develop expectations for future performance arguably also increase. It's true. You can make that assessment. Look, what is low financial reporting quality? When financial reporting quality is low, what happens? Earnings quality cannot be assessed. Yes, it's true. For an example, look, consider erroneous financial statements. If there is erroneous financial statements, if the information presented is materially incorrect, it would be useless in assessing whether the company performed well or poorly. If you don't have correct information, now in the previous one also same, that's the point I told you previously. If you are going to assess the performance, let's say as investor, if they are providing wrong information, can you assess it? You can't. So that's why we say, if the earning quality, if the financial reporting quality is less, you are not in a position to assess earnings quality. Right. High financial reporting quality. High financial reporting quality is, if there is any high financial reporting quality, it is possible to assess earnings quality. High earning quality. Usually high earning quality means, look, when earnings quality is high, the value of the company increases. How it happens? How it happens? Low earning quality, when earnings quality is low, the value of the company decreases. How that happens? Low earning quality means you are not presenting your information, you are not generating what is called profits and cash flows from real economic activities. That's why you don't show. Don't show means less reporting quality, means obviously what's happening there? Less earning quality. Understand what I say? Very simply, if you have good performance from real economic activities, what will happen? You show it, no? Understand what I say? If you have bad performance, bad financial position, what happens? Your tendency, do you like to show as it is? Nobody like that, no? So that's obvious thing, no? Nobody will really willing to show the bad things. That's obvious thing for any human being. Like in financial statements also. So therefore what you can understand, low reporting quality indicates that, what is it? Low earning quality. Understand? Right. Vice versa also same. If low earning quality, basically it doesn't happen. Even sometimes low earnings quality, there may be high reporting quality. Can't it be? There are some genuine people, let's assume, genuine people, even though the low earnings quality, they report as it is. What is that thing? Low earning quality, but good financial, so quality financial reporting. Understand what I said? Now, this kind of confusion thing. Even low earnings quality, sorry, if low reporting quality, your conclusion, definitely earnings quality also low. But there may be some cases where low earnings quality but high financial reporting quality. Why? They are genuine people, they report as it is because of some legal restrictions. You have to disclose as it is. You disclose as it is means your reporting quality is high. Understand? Look, there is example there. High quality earnings reflect an adequate level of return. Excuse me, 1 minute. Right. Look, high quality earnings reflect an adequate level of return on investment. High quality earnings reflect an adequate level of return on investment and are derived from activities that the company will likely be able to sustain in the future. Why? What's the reason? Also, they say, thus high quality earnings increase the value of the company more than low quality earnings. Why high quality earnings increase the value? High quality means definitely they will report it. High quality means you have enough of good performance and good financial position of the business. Low quality means it is not so. When reported earnings are, look, very clear, very important point there, down. When reported earnings are described as being high quality, it means that the company underlying economic performance was good. Look, that's the point. When reported earnings are described as high earnings quality, reported earnings are described as high earning quality means they have enough economic activities to generate income and cash flows. It means that the company's underlying economic performance was good. That's why we said value is increasing. And it also implies that the company had high reporting quality. Yes, why high reporting quality? They report everything as it is. High reporting quality, that is, that the information that the company calculated as and disclosed was good reflection of economic reality. They have good economic reality and the cash flows and performance, they report it as it is. It means high earnings quality and high reporting quality. But sometimes what happens? If you have low reporting quality, obvious that, what is it? Low earnings quality. But there may be a scenario, I think it's in next slide. Earnings can be termed low quality. As a result of that, look the first point there. Earnings can be termed low quality either because the reported information properly represents genuinely. Look, that's what I said previously. Earnings can be termed low quality either because the reported information properly represents genuinely bad performance, or because the reported information misrepresents economic reality. It means one side they misinterpret the economic reality. Oh, actually they are bad. Therefore, what they like, they don't disclose sometimes. Therefore, we call it low quality, right? Consider a company with low quality earnings. For example, one whose only source of earnings in a period is one-off settlement of lawsuit, without which the company would have reported huge loss. Look. But what they do? They just report as it is. Then what is that? The second sentence, the company could nevertheless have high reporting quality. Why? They have reported it as it is. Understand? So then they are in the earnings quality is high. Why? They have charged it to profit and loss account. But still they have disclosed it. Oh, sometimes they have not taken it, but they have disclosed it. Understand? It means earnings quality is high. Sorry, low earnings quality, but they have high reporting quality. The last bullet there. Although it is theoretically possible that a company could have low quality earnings while simultaneously having high reporting quality, that's what I said. High reporting quality, but there may be what? Low earnings quality. It means they are bad performance, their cash flows are bad, but they report it as it is. It means even though less earnings quality, they have what? High reporting quality. Right, look the model that we discussed up to now. When there is any low financial reporting quality, obvious, what is it? Earnings quality is low, right? But high reporting quality means high earnings, right? And it increases company value. Then high reporting quality together with low earnings quality, what will happen? High reporting quality will enable you to make good assessment. Understand? Because there you have enough information with you. As a result of that, you can make judgments very accurately. But on the other hand, what happens? Low earning quality decrease the company value. High reporting quality means, like, let's say poor performance, but they report in good way. Poor performance means anyway what happens? Value will be decreased, but you can make judgment very well. Why? You have enough information with you. So that's what we call reporting quality. Here there is another bottle. You can see very carefully. Actually, this is like called quality spectrum of financial report. How the quality is deviated, right? This is kind of a big thing, but we'll just try to summarize as possible as we can. Look the point there. The most desirable situation is when the company has high quality earnings and presents this information in high quality financial reports. It's obvious, no? හොඳයි නම් කවුරුත් ඉතින් හොඳයි කියලා පෙන්නනවනේ. හොඳ වෙලාවට නරකයි කියලා පෙන්නනවද? No. It's very rare, no? If we are good, we don't say like we are bad. Understand? It means high earnings quality means obvious that high reporting quality. But it doesn't mean that low earnings quality is always, high reporting quality is always high earnings quality. We don't say like that, right? Look, essentially, the analyst needs to consider two basic questions in this case. When you think about this reporting quality, you have to focus about two basic things. Are the financial reports GAAPs or IFRS compliant and decision useful? That means whether the financial reports are compliant with necessary reporting requirements. GAAPs, IFRS, all other accounting principles, concepts, everything. And also, are the results or earnings of high quality? In other words, do they provide adequate level of return? Look, and they are sustainable. Otherwise, no point. No? Even though you make decisions, no point. You have to see whether they are providing adequate return to who? To its stakeholders. It means the return should be greater than its cost of capital. Nothing adequate return which is less than that. Return should be the investor greater than the investor's cost of capital, and also that return should be sustainable enough. It means you are achieving high earnings quality. earnings hondai කියන එක. It is good. But you have to think whether you are coming with all these reporting requirements. Understand? Right, we'll see. In the model there you can see there are a few terms. Decision useful, GAAP, general accepted accounting principles, refer everything, US GAAPs, IFRS, all home country accounting standards and everything we refer there, it's there, right, you can see. This area, right? Quality reports that provide decision useful information about high quality earnings, that's what I said. Quality reports that provide decision useful information means high reporting quality. That's what we, sorry, made a mistake. Yeah, high reported quality, it will become high quality earnings. There are three terms there. Decision useful, what do you mean by decision useful information? It means it embodies characteristics of relevance and faithful representation. Second one, high quality earnings provide an adequate level of return and it should be sustainable. To say high quality earnings, there are two conditions to be satisfied. What are those? You should have adequate return, means it should exceed your return equals or look in excess of cost of capital. Also, it should be sustainable. Sustainable indicates that the earnings are derived from activities that the company will likely be able to sustain in the future. So that means the earnings arise from the day-to-day operation activities which can be happen in the future as well. Little technical in this area. The sustainable earnings that provide a higher return on investment contribute definitely, what is it? If you can remember, in valuation, higher valuation. Understood? Why? Your expected cash flows will be high. Also, GAAP or the IFRS compliant, decision useful information about how quality earnings, they can be low quality because they do not provide an adequate level of return, or they are not sustainable. If so, definitely it is low quality, low earnings quality. If you are deviating from this, sorry, made a mistake. If GAAP compliant information but less decision useful, that means you don't have relevance and faithful representation, then what will happen? Bias accounting choices result in, it means you are not relevant, you do not keep relevance and you do not keep faithful representation, means bias accounting choices result in financial reports that do not faithfully represent economic phenomena. Therefore, what will happen? It will be about low reporting quality. Another area. Look this up. GAAP compliant information but reflects earnings management is low on the spectrum. Earning management is low means, an example is there. Earning management is earnings smoothing. That means you are trying to manage the volatility of earnings. We call it earnings management. In some years it's high. Now, if you can remember in the previous financial statement, we easily trace out. In the 2004 year, can you remember? Last year it was highly volatile. Therefore, everybody understood that. What is that? There is some problem inside it. Therefore, what people do? They don't do like that. They need to manage it properly. They should not show big volatility, but big variations. So that kind of thing we call earnings smoothing. So then earning volatility is decreased by the understating earnings in a period when a company's operations are performing well and then overstating earnings in periods when the company's operations are struggling. The next levels down on the spectrum are if you can remember, when it comes down, what happens? Financial reports. Look, it's here. Vishan. Look, this area. What happens? Financial reports that depart from GAAPs or IFRS. It means definitely what's happening? Low reporting quality as well as low earnings quality. That's why they departed from. They don't have good earnings. That's why they need to do some changes. It means low earnings quality as well as low reporting quality. Same, it will further worse if the scenario is like this. Fabrications are not useful to assess earnings quality at all. Potential problems that affect the quality of financial reports. When you think about financial reports quality, timing, I'm not going to explain one by one, but you can read later if you need. Reported amounts and timing of recognition. Based on that, what will happen? Your reporting quality will be changed. Classification. You can do a lot of classification kind of, let's say, problems. You do not classify those properly sometimes. Sometimes you can remember some items you will classify as cost of sales, while some are classified as what is called operating expense. Buyer's choices. In IFRSs, we have a lot of choices available. You can make a lot of judgments. Based on your judgments, you can decide either you are recognizing something in different elements. You can remember, even in financial instruments, based on the conditions, you can decide whether it is fair value through profit and loss account or something else, amortized cost, something like that, based on your judgments. Also, there may be some fruits, those affecting to the reporting quality. Those information is there, but I don't explain one by one. You just read those later, because we don't have time. Otherwise, I wanted to discuss at least part of this, but I need to show you one few. Look, accounting warning signals. There are some potential issues. Overestimation or underestimation. Now look, how to catch it? That's kind of important aspect. Growth in revenue. Look, warning signs, we call them red flags. Previously we took red flags. Growth in revenue higher than that of industry or peers. It means there may be kind of unexpected thing. Even in our villages, same. No? If one person is becoming rich very fast, people have kind of doubt. There may be kind of something different inside him. It is unusual. That's the reason, right? Maybe sometimes he is genuine, but still people have kind of doubt on that. Increases in discounts and other returns from customers, another doubt area. If you have more returns, I told you previously, if you give more discounts, that means there is question on that. High growth rate in receivables than revenue. High growth in receivables than revenue cannot be. Why? That rate should be taken parallelly. At least if sales are growing, you should have less receivable growth. If the receivable growth is high, you have to be careful. Why? That means you do more credit sales to boost your sales. Large proportion of revenue in final quarter or year end, it means seasonal variances. So that's why I said even in returns, if you analyze properly, there are some organizations where they have more returns at the beginning of the year. It means they boost last year's sales. That's a hint. Understand? Something like that. Yeah, some others also there. But here you need to show you one more thing. How do we evaluate or how to decide whether financial reporting quality is there? The financial reporting quality is there. You don't want to be afraid to make decisions on that. Understand? Look, they have given some. You can understand with these terms even. Understand company and industry. It's important. I told you at the very beginning lecture, if you can remember. Before doing this financial statement analysis, what you need to do? You have to understand the nature of the industry and, excuse me, one thing. Learn about management, and also you have to, because based on that you can understand what they are going to do, how they report. Identify important accounting areas like using ratios. You can do the same. Compare them. Thereafter, look, this is what we did today. Check what for red flags or warning signals or warning signs. Review segment results, and this is quite difficult. Use quantitative predictors or misreporting. How to do that? That's an area I need to show you finally. There's a model here. Those are things I explained. We call it M-score model. This is a very important thing if you do research. This is kind of predictors that these are variables and these the figures or the probability values are given as a result of the research. We call it sometime this is Benich model, right? So look, based on that, you can apply as it is. These variables also there. Though all these are predetermined, you can't change it. Look, variables are defined there. How to calculate and in the meaning. SDR means sales days receivable, days sales receivable. Receivables divided by sales, divide by receivables into sales. Other way around. Right? So then you see that it shows the changes in relationship between receivables and sales. If there is any improper revenue recognition, it will be caught by that. Likewise, there are variables. After putting everything into this model, you will get values. Look here. If M score of less than 2.22 suggests that the company will not be a manipulator. Look, with that what you can do? You can decide whether they have manipulated figures. If the M score is greater than 2.22, signals that the company is likely to be a manipulator. Good thing, you just see, at least you take 1 or 2 financial statement and test. Actually, I wanted to do the same for the previous question, but today we don't have time. The balance sheet and income statement previously we took, because there were manipulations. We concluded with ratios and our general understanding, there were some problems in GT1, in the first part I did today. There were manipulations. We noticed that there were manipulations by looking at sales figures. From credit card sales, expenses and all, we guessed that. If you put into this model, you can make sure further whether they have manipulated. It means, if you get more than 2.22, what is your conclusion? They are manipulated, because it means low financial reporting quality. Means obvious that, what is it? Low earning quality. Understand? So that is our conclusion. There are some other areas I wanted to discuss, but we don't have enough time. You just read it. It is not that much important actually in this level, but I wanted to show you this information and share with you. If you need or if you do research on this area, this will be helpful. Otherwise, for the examination focus, no need to focus that much on this. With this, we will wind up the session, and hope we have done little areas in this. I did only 4 sessions. Chatru did business elevation. Actually, Anrusa will do revision. Otherwise, I wanted to do a case study with revision, but when I see the schedule or the course outline, there is a separate part to discuss. That's why I discussed today this part. Then Anrusa next week will take the lecture and will discuss some revision questions covering all the areas. And with that, I think people, I think I don't have further lectures, no, for you. There is 1 lecture for financial reporting issues, no, for me. 2 lectures. Next and following week. How is it? It's for me. Yes, 2 lectures are pending. I'll check it anyway. The finance people will not meet me again, I think, in lectures, but only accounting people will meet me. Accordingly, wish you all the very best for the examination and for the future of this program as well as future of your life, especially for finance people, because I'll not meet them in a classroom if you are not coming for the second year. If you come for the second year sometime, still I am not sure. We will meet anyway. Now all the very best for your examinations coming in the next month. And for accounting people, I'll have 2 more lectures. That's for financial what's called contemporary accounting issues, no? Financial reporting issues. So then with this, we will wind up the session, and thank you very much for your participation. Thank you.